Hello, everyone. My name is Kunle Jimba again. Today, we're going to be talking about some very important economic indices that is being used by the Central Bank of Nigeria to control the flow of money in the economy. I'm sure a lot of us must have heard about the difference between when they talk about fiscal policy and monetary policy. In the previous administration, we've had issues where these two arrangements doesn't align. So you see the monetary policy saying something else, and then you hear that the fiscal policy, which is controlled by the Ministry of Finance, and the monetary policy is controlled by the central bank governor, are not aligning. So you hear a case where the Ministry of Finance will say he or she is not aware of what the CBN policy is saying about maybe FX policies or one or two other issues. So we'll break it down. There's something they call MPC. That is the Monetary Policy Committee, you understand, and they meet regularly, maybe on a quarterly basis. Is constituted by some number of individuals as selected by the ministries and government organizations. So they meet regularly to determine how money flows in the economy, how money is utilized in the economy, and they set the tone for each quarter. They watch the economy, they watch FDIs, and then they determine how Naira is applied, you understand, and the value that it will carry. So they wield this power every quarter to shape how money flows in the economy. So first on the list, when MPC committee meets, then they set the MPR. What is MPR? That is more monetary performance ratio. What the current one that was set last is about 27.5, and CBN has maintained this ratio quite for a number of times. And people often ask to say, why is the MPR ratio very high? Well, we all knew that the economy of the country almost went into recession, and it got to a point where dollar was almost selling at 2,000 naira, and people even forecasted that it will go as high as 5,000 naira. Why is this? It's because of the scarcity of dollar. And when dollar is scarce, Nigeria was imports dominated economy then. Even as little as toothpick we import from outside the country. Nigerians have very high sophisticated taste. They prefer imported items, to use. So it puts pressure on our Naira because everybody was chasing FX, and there were a limited supply of FX because we were not exporting, you understand. So that's why the price was very high. Now what the government needed to do was to create an avenue where investment in Naira will become very attractive, and the only way it can be attractive is to jack up the rate on treasury bills, so all these government bonds and what have you, and if you have to jack up rates on that, it means that also the lending rate must also increase, do you understand, so that you can also recoup your investment. So that was why government jacked up lending rate to 27.5 so that they can also increase the yield that they'll be giving on treasury bills, because if they are not making money from lending, then it means that they cannot increase interest that will be paid on those investments that you'll be putting in the treasury bills or in any of the government regulated bonds. So that was why they increased the rate. So when this rate increased, it outperformed other ratios around the world, and made sure that things people are looking towards Nigeria, you understand. So it outperformed other investments around the world, and because of that encouraged investors, especially portfolio investors around the world, to bring in their dollars into the country because they felt that this is the only place where they can get maximum yield on their portfolio investment. You imagine somebody bringing in money and cashing in at 21% per annum on a treasury bill. In the likes of US, the best you'll probably get is 4% yield, or maybe 3% in some places. Most economy are doing maybe less than 10%, and Nigeria is offering about 21 on yields as at that time. So we witness a lot of inflows because of that singular policy. Now, there's something that the MPC also calls the CRR. CRR is at 50%. That is cash reserve ratio. And this specifically affects the commercial bank, the deposit money bank. So it means that if they have a total funding of say 100 billion in the coffers of CBN, who is their lender of last resort as a reserve bank, so it means that their CRR will be 50% of that money, which means that 50 billion of that 100 billion will sit with CBN and they can't touch it to do anything. Do you understand? So they must maintain that balance of 50 billion, which is 50% of their total cash equivalent reserve with CBN. So this is also used by CBN to curb to a large extent them lending, because we saw that inflation was very high, and the only thing that drives inflation is when the economy is saturated with money. So everybody has money. People who are not even productive, they have money. So monies that are not chasing real sector development or infrastructure or activities is sitting idle. And we all know that in the previous regime, we heard the story of how 30 trillion was printed without any project being attached to it, and people shared the money. So people had a lot of cash, so they can as well buy a lot of this. So that's why you see that people can frivolously go and buy houses. You saw that the prices of houses skyrocketed because they have free money chasing no goods. So people don't know what to do with that money. People who have that money, I don't want to use the word embezzled or stole, but I just want to say people have that money. Whether they work for it or they didn't work for it, they just have the money. So they can buy multiple things and waste it. Things they don't need, they can buy. And that's what creates inflation. You understand? Where you just want to buy. Even if they call it 1 billion, you don't care because you have the money. You just buy it. Even if the value is not right, you just want to buy it. So that's what causes inflation. And until you reduce money in circulation, you cannot curb inflation. So that's why the CBN also thought it wise to say, okay, CRR 50%. So bank will have limited funds to lend to the economy, such that the economy will be able to improve itself. If there is limited funds in the economy, then the people will have also limited access to cash. You understand? So that's what CRR is speaking to, really. Then we'll move on to what they call a liquidity ratio. Liquidity ratio, CBN set it at 30%. So they further drive again to say the bank must maintain liquidity ratio of 30%. You understand, from their funds. So invariably, we are talking almost about 80% of the bank's funds are sterilized with CBN that they can actually touch. But you see, this liquidity ratio means that at any point in time when you're operating, you must have at least 30% buffer. You can't create loan that will usurp your 30% because it's a deposit money bank. The owners of these funds can come and say that they need their money. It's a call account, you understand? So banks can't say, when the depositor come and say, I need my money today, banks can't say, come back tomorrow, I don't have cash. The moment they say that, there will be a run on the bank and the bank can collapse. You understand? So CBN set that liquidity ratio to be 30%, that they must be afloat at all times. You understand? So that's a very key tool in the banking industry. Now they said something about asymmetric corridor. Asymmetric corridor, they said plus 500 or less 100. So what this means is that there will be possibility that some banks will be overrun and they will need cash cover from CBN. So what they are trying to say is, for example, if a bank, let's say you have 10 billion with CBN and you have demand or need for 15 billion, your customers, you want to create loan, you want to do this or that, considering the fact that you need your CRR at 50%, You need your liquidity ratio at 30%, that's 80% already. So you now need additional money to create loan. You can borrow from the CBN as a bank. But if you are borrowing from the CBN as the bank, we said that MPR is set at 27.5. So the asymmetric corridor will now kick in, which is plus 500. So if a bank is now borrowing from CBN, that means you add 500 basis points to that 27.5. So that means CBN will lend to that bank at 27.5 plus 500 basis points, which is 5%. That makes it 32.5. So it means you now borrow from CBN at 32.5. So imagine if a commercial bank takes money from CBN at 32.5. Imagine how much they're going to give it to a customer, because the minimum they will do is to have at least a margin of, say, 10% to cover their own expenses and some other things. So it means from 32.5 plus, say, a 10%, it means the bank will be lending at almost, say, 42.5. If they are conservative enough, maybe they just put a margin of, say, 8%, 800 basis points. That means they would lend at maybe 40.5. So in essence, it means that the cost of funding to that bank ab initio is 32.5. They will now add their own margin, add their own cost of operation and everything to you. So you can see that money became very expensive in the market, and only few people can actually borrow. And then that limited the money in circulation, and then that reduced the purchasing power of people, and then it will curb inflation, because if people can no longer buy, then marketers and sellers will be forced to reduce the price of items they are selling. Because, for example, you have perishable goods, you have placed 1,000 naira on tomatoes, and you have in hundreds of thousands of baskets that you want to sell, and people are not coming to buy because they don't have enough money, or people who are buying one full basket before can no longer buy a full basket. They now say, give me a quarter of a basket. You have no choice than to reduce the price so that people can buy, and that's how you drive down inflation. Now, on the other end, on that asymmetric corridor, they also said there is a minus 100 basis point. So what does this mean? It means that for some banks that are very, very buoyant, so you have excess money and then you're giving to CBN. For example, on that your cash reserve ratio and whatever, you're just pumping money to CBN and you want to give to CBN overnight. So CBN is saying that they will also pay you interest on that money that you have given to them. And what interest they are paying you, it will now be that MPR less 100 basis point, which means that MPR less 1% is what CBN will pay you as rate, which is about 26.5. Yeah. So for those who have enough money, cash cover to give to CBN, they will earn 26.5. For those who will borrow from CBN, they will pay CBN 32.5. So that's the analogy around MPC committee meeting and setting of MPR. So I'll see you on the next one, and we'll talk more about the macroeconomics and what it means for the country Nigeria and for the world at large. See you then. My name remains Kunle Jimba. Thank you very much.